Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 22nd, 2023. I hope you're doing well. I hope you had a good trading week. I hope you're going to have a good weekend. And thank you so much for coming to today's podcast. This is my weekend review in this podcast. Let me give you the format. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made this week, both on the daily time frames, the weekly time frames, and the monthly time frames. We're going to talk about why I entered the position, when I entered the position, and most importantly, how I am going to manage the position going forward. Looking for your entry signals, combination, confluences of indicators, not that hard, but the management of the trade is really the most important. That's what's going to be the difference between you being a profitable trader or an unprofitable trader. And really what that comes down to, the process that I use is I look for rejections. If I'm going long, I'm looking for some kind of rejection of a major level, such as the 200 SMA, the 250 SMA, the 300 SMA, yeah, a 30 RSI. These are all called deep dip buy stock trading strategies that I use. Now, I use 5 different strategies, but a lot of the trades that I have taken lately have just been the deep dip buys. But there are a couple on here that are different strategies, and I'll go over those as well. So we'll talk about when I bought the trade, why I bought the trade, and how I am going to manage it going forward. But looking for that rejection of the level, regardless of the trade, looking for a rejection of the level, position sizing based upon the current volatility of the market, knowing where your end of day stop is, knowing where your emergency stop is, knowing where you're going to go into trailing stop mode, and what the process is going to be from there. You have to know exactly what you're going to do regardless of what the market does. The only control you have in this market is being patient, waiting for uh, your entry signal, some kind of rejection of some kind of level, ideally looking for rejections of levels on multiple time frames, position sizing, like I said, placing your emergency stop, your end of day stop, and then letting the market do what it's going to do. But you have to know exactly what you're going to do. You have to have if-then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. But what it really comes down to is getting out quickly when you're wrong and having a process that you can let your winners run to the upside. You can have large wins in trading. That's fine. Obviously, you can have small wins, you can have break-even trades, and you can have small losses. But you have to configure a trading process that takes all these things into account. And I will discuss this later in the podcast, but I'll just mention it here as well. I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course, 5 sessions. Each session is 3 hours. And I will teach you step by step all the 5 trading approaches that I use. I taught last week quite a bit, and really like teaching, really like seeing students going, oh, now I get this. Oh, that makes sense. So if you're interested, my email is in the link of this YouTube video. Just go ahead, send me an email, and we can get the discussion started. But I will get into this more as we go on. So anyway, that's after I go through the current trades and explain everything. We are going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to be patient and follow your rules. And that all comes from between both of your ears, which is your mental mind state. And it's so important. So I do like to talk about trader psychology. It's helpful for me to teach. I hope it's helpful for you to listen to, but we'll do a few minutes on that. After that, I have gone down through my master watch list, and I've gone down through all the charts on the master watch list, both on the daily time frames and the weekly time frames. And I have identified a handful on each time frame. Now, keep in mind, where these markets are at the moment is not where I need them to be. But I'm going to look for next week for them, if they go down, to possibly reject some type of level. So they're not ready to go. They're not buys for me right now. I have to wait and look for some kind of rejection of a level to give me some intelligence on that, hey, the market doesn't want to go lower from here. So I will point those out, and hopefully that will give you a good idea of how I look at trading and how I look at these levels. And so I hope it's going to be helpful for you. All right. So first of all, I've got to run before we get into all that, I've got to run the U.S. legal disclaimer. Hang tight. I will be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me, and let's get started. Okay, had a really good trade on SLV. And we'll go through that. And before the legal disclaimer, I was talking about looking for a rejection of a major level. Well, here on SLV, all the way back on the 23rd of June, I bought SLV because it rejected the 200-day moving average. This is the 200-day moving average, this black line. In addition to that, it also rejected the negative third ATR channel, which is important because 92% of prices tend to stop going down, move sideways, or go up when we get to the negative third ATR channel. So that, in conjunction with the rejection of the 200, is a very strong level, and it gives me a very good line in the sand to base my trade upon. So I entered here 2056. I position size correctly based upon the volatility of the market, and I placed my emergency stop. Let me show you just very quickly on the position sizing. Basically, the rule of thumb is, a good rule of thumb is 1% of your capital. So let's just assume we have a $100,000 trading account. So $100,000 times 1% is obviously $1,000. I take $1,000, I divide it by the value of the 2 ATR. That's factoring in all the volatility. Very simple, do this, and it tells me to buy 1,333 shares. Then, so I see the signal, I position size, I do the math, I position size correctly, I enter the trade, and then I place my emergency stop exactly 0.75, in this particular case, below my entry. So if I have 1,333 shares that move 75 cents, how much have I lost? I've lost that $1,000. That's the max, right? In most cases. Of course, it could gap down below that. Now, that's going to happen very infrequently. That's only going to happen about 5% of the time. The other 5% of the time, you'll be looking at an end-of-day stop. Well, end-of-day stop is, why did I take the trade? I took the trade because it rejected the 200-day moving average. Therefore, in the future, if it just closed below the 200, I would just immediately get out for a small loss. Okay, now that's everything to the downside. Emergency stop, end of day stop. To the upside, whenever it moves the value of 0.45 ATRs to the upside, I take partial profits. I want to lock in partial profits as it moves. So I took a little profit here, I took a little profit here. Then we came back down, underneath the 200, but it closed above the 200. The 200, or all of my swing trades are based upon the closing price, not what it does intraday. The only thing that would come into effect intraday would be the emergency stop. Yes, if it got down there, I would not wait for the end of the day. I would just get out immediately because I have lost that $1,000. But the end of day stop, looking for a close below the 200 because that was my signal. So on this day here on the 29th of June, yes, we opened below but closed above, kept me in the trade. Next day moved up, took a little profit. Next day moved up, took a little profit. Next day moved up, took a little profit. Then all the way back down, but we held the 200-day moving average, so I'm still in the trade. Then we moved sideways, and then we exploded. I did exit on Thursday at 22.69 for a gain of 9.35% on the remaining shares. And why did I exit? Well, I exited. Normally, I would exit if we rejected the 70 RSI. I would exit half, but it did not reject the 70 RSI. It but it did get to a 65 RSI level, which is a very high level, and it makes the 5 EMA trail it very closely. And the rules that I use and the rules that I teach is if I ever get to a 65 RSI and then I have a close below the 5 EMA, then I'm completely out of position. And so, again, rules, you can use your rules. I use my rules, but the key is follow your rules, because if you're using good trading principles, something like rejecting the 5 EMA after you get to the 65 RSI, it's good. It makes sense. And you can see this was a wonderful trade. Enter down here at 2056, exited the remaining at 2269 for a gain of 9.35%. I am completely out of SLV now. All right, next trade, VIX. I did take VIX back here on the 19th of July. A lot of reasons why I took this trade. First of all, I want to point out the double bottom bullish divergence going on. You might say, what is that? Well, this is something that I learned studying one-on-one with Dr. Alexander Elder, and double bottoms bullish divergences are his favorite setup. He thinks it's the strongest trading strategy technicals in trading, and they are very good. Only thing is they don't happen very often, but VIX is certainly in that position. You see the low we have here, you see how deep the red MACD bars are. That indicates a lot of selling and a lot of selling momentum. Well, then you need a bounce and you need the MACD to go green, which it is green here. And now look, are we lower here than here? Obviously. But do you see how we have only green bars here? We don't have any red bars. This is called a double bottom bullish divergence and a missing right shoulder. All it means from a MACD perspective is that this move down was not as strong as this move down, or in other words, we're running out of sellers. And if you run out of sellers, the implication is that you are going to go up. So I didn't take the trade because of this double bottom bullish divergence, but at a high level, this really added to the context of the trade. But then I was looking for a valid signal. The valid signal came here on the 19th when we went under the 30 RSI and closed back above the 30 RSI. We also had a V1 entry trigger, bar 1, bar 2. Bar 2 goes below bar 1, closes above bar 1's close. And in addition to that, we also washed out the low of the previous range. So there are a lot of signals here. Doesn't mean it's going to work, but I did position size by taking my maximum allowed loss, dividing by the value of the 2 ATR. I then placed my emergency stop exactly the value of the 2 ATR below. And then what's my end of day stop? Well, on an under 30, over 30, simply my exit, my end of day stop is if we close back below 30 RSI. Then I am completely out. If I get to my emergency stop, that's the worst case scenario, and we know what we're going to do there. We're just going to go ahead and get out. So double bottom, bullish divergence, under 30, over 30, plus a V1. And by the way, if you're interested in learning more about V1s or V2s, I use them all the time. I think you really, really like them. I have a free video on YouTube, my YouTube channel, in the lessons playlist called V1 and V2 entries. So you'll probably hear, if you listen to this podcast, you're probably going to hear me talk about them a lot. I like to look for confluences of signals. And the main signal was the under 30, over 30. The secondary signal was the V1 entry trigger. Kind of the big picture context was the double bottom and bullish divergence. So, this all sounds like it's a lot. Does it mean the trade's going to make money? No, it does not, but it does help the odds. So, bought here at 23.80. Currently, it's 23.70, so it's down 10 cents. But the key point is that look at the RSI over here in the bottom right-hand corner, 31.16. It is still above my end-of-day stop because it has closed above 30 RSI. So this trade is down very, very slightly. I'm hoping for good things for this trade. Well, I hope for good things for every trade, actually. I'm down 0.42% on the trade so far, but I'm remaining bullish on VIX as long as we stay above the 30 RSI. All right, those are the two dailies. Just a quick recap, SLV got out for a gain of 9.35%. VIX currently down 0.42%. And then here is a closed out daily trade. All right, this was a short on Morgan Stanley. I shorted Morgan Stanley back here on the 3rd of July when we had a um, rejection of the 200-day moving average. We went above it, closed below it. So that's bearish to me. Got short at 86.52. I position size correctly. I placed my emergency stop 2 ATRs above because it's a short. And then my end of day stop is simply a close above the 200. Now I place my 1.5 ATR trailing stop level below. And once I get there, then I go into trailing stop mode. Next day went down. Next day went down big. Did take some partial profits, reduced my position size because I always like to take partial profits when the market moves my way. So hit 2 profit targets on this particular day, also in trailing stop mode. Next couple days we move sideways. Next day we closed above the previous bar's close after reaching trailing stop level. So I locked in half of my position and reduced my position size by half. And that particular gain was right about 1.92%. Then we move to the upside. But remember, my end of day stop is simply a close above the 200. Went above the 200 during the day, closed back below. Next day, inside bar. Next day, opened above, closed back below, kept me in the trade. Next day, again, could not get back over the 200, but the next day was earnings, and I never hold through earnings. It's the fastest way to lose a lot of money. Yes, you can make a lot of money as well, but it's the fastest way to lose a lot of money. So I exited the trade for like a 0.10% gain. But the more important part is, look, if I would have held this short, lots of pain there because the earnings, the market liked the earnings. All right, so it's a good example of why not to hold through earnings. And also this week, Netflix, Amazon, the market did not like their earnings either, and they went down double digits. And so it just shows you that, yes, it's a good policy to get out before earnings because you are, as a trader, your first responsibility is managing risk, and holding through earnings gives you a lot of risk, and you should not do it. Okay, makes sense. All right, let's get over to the weekly trades. These are on the weekly bars. These trades are decided on Friday because it's the last day of the week. Now, I have been in this trade for a long, long time. I went long IWM all the way back here, 1014, near the lows of the market. Why did I enter the trade? Well, see the orange line here? The orange line is the 300-week moving average. This is an important level. It gives me a good level to key off of. Do you see how during the week we went significantly below the 300, but then we closed above the 300? That shows me that the market is respecting this line. So I position size. I place my emergency stop 2 ATRs below. I place my 1.5 ATR trailing stop level above. And I got long 167.19. All right, and if it closed below the 300, I'm just out. Well, the next week moved up nicely for me, took some profits. Next week moved up again, took some profits. Next week after that, got to trailing stop mode, which means if I have a close below a previous bar's low, I will get out. This happened here on the week of December 9th, where we had the first close below the previous bar's low after reaching trailing stop level. The remaining shares that I had, I locked in a gain of 6.53%. Then we came back down but held the 300. Then we had another big move up where I continued to take partial profits, reduce my position size at profitable levels. Then we had a big swing down, but you see how we held the 300? Here we bounced. Next day we went below, closed back above, stayed above, tested the 300 again, tested the 300 again, tested the 300 again, but it did not close below, so it kept me in the trade. And over the last couple months, we have just moved up strongly where I've taken partial profits, and last 2 weeks have been very strong. So the remaining shares that I have on IWM are currently up 14.06%. Pretty good. XLF, another deep dip buy approach. And by the way, like I mentioned earlier, I do teach this deep dip buy as one of the 5 trading strategies that I use in my one-on-one courses, and I will teach you step by step. But excuse me, I also teach the deep dip buy trading approach on an online course on udemy.com, and the link to that course is in this YouTube description. It's very affordable, somewhere between $12 and $15. If you like what you see here and you would like to take a look at that online course, it's very affordable, and the link's in the description, and I teach you in there exactly how to trade this. So I bought XLF all the way back here near the lows. What was the signal? Well, the purple line here is the 250-week moving average. That's an important level that I want to see being rejected. Well, we had a huge sell-off. We bounced here at the 250. I got long at 30.71. I position sized as I always do, based upon the current volatility. I placed my emergency stop, and where's my not end of day, end of week, because these are weekly bars? Well, it would simply be a close below the 250. That's it. Very simple. Place my trailing stop level up here, 1.5 ATRs above, and it moved up, took some profits. Moved up again, took some profits. Then I got to trailing stop mode, which means if I have a close below a previous bar's low in the future, I will get out. We never had a close below the previous day's close until the week of 6/23, where we did close below the previous bar's low. I got out for a gain of 6.4%, but not all of it. And the last month, we have rallied up strongly. Big week again this week on XLF. Took off some partial profits with my partial profit taking approach, and the remaining shares that I have up 12.99%, all based upon this rejection of the 250-day moving average. If I was wrong, I'd probably be wrong. In worst case scenario, I'd lose 1% of my account. But 95% of the time, I'm going to lose much less than that. And that's really what profitable trading is about, everyone. Identifying a level, position size. If you're wrong, getting out quickly with a small loss. If you're right, having a process to stay in like this. So the remaining shares up 12.99%, which is really great. XLE, okay, finally a different trading approach. And again, this is one of my favorite trading approaches. And again, I teach this in my one-on-one course. This is called a higher low V2. I learned this from studying one-on-one with Carrie Lavorne. Really love higher low anything, whether they're higher low V1s, V2s, higher lows, rejections of the 200, 250, or 300. But essentially, on a higher low V1 or V2, you see the two green lines here. This is called the value zone. What the requirement is that I need to close below the value zone, like the price action did, rally into the value zone, like it did, pull back, and then wait for a V1 or a V2 entry signal. This is a V2, consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. My entry price was 36.32, but the key point is, you see how this low here is higher than this low? This makes it a higher low V2. Now, I position size, I place my emergency stop 2 ATRs below. Now, there's no 200 or 300 or 30 RSI involved here, so I need to know where my end-of-day stop is. Well, on a V2, your end-of-day stop is simply a close below halfway of the washout bar. Bar 2 is the washout bar. So if I got to close below this line here, I'm simply going to get out of the trade. Well, moved up, took some profits, moved up again, took some profits. Now, the key point here that I want to show you is this move down, closed below the previous bar's low, but I didn't get out of half because it did not reach my trailing stop level, which was 1.5 ATRs above my entry. So the key point is, why did I place my stop at halfway of the washout bar? Well, the halfway from a Fibonacci standpoint is very important. You see how he came down literally and just, it put the brakes on and stopped? And then the next week, it actually tested it, like almost to the penny, but didn't close below, did it? It triggered, backfilled, and then up we went. And I had a lot of profits here. Last week had a lot of profits as well. And the key point too is the orange line here is the 1.5 trailing stop level. So I am now in trailing stop mode, which means in the future, if on these weekly charts, if I have a close below a previous bar's low, I will get out of half. So no trailing stops have been initiated here, just taking profits on the way up. And this particular trade doing really, really well on the weeklies. Let's see. Up about 5.85%. So higher low V2, really good one. All right, last but not least, love. Let's talk about love. Not a bad thing to talk about. This is a monthly trade, and I do take trades on the monthly charts as well. You've seen that I've shown you dailies, I've showed you weeklies, and on the monthly as well. I take these trade on the last day of the month. This is Love Southwest Airlines. I bought Southwest Airlines all the way back here at the end of May at 29.60. Well, look at the chart. Can you take a gander, take a guess of why I took the trade? That's right. I took the trade because we rejected the 200-month moving average. It gives me for one, I know there are going to be buyers that come in at that level. So it's important to get into a trade where you know buyers are going to be coming in, or you can assume they're going to be coming in. Well, look at this. During the month, we went below, closed back above. The market had been respecting this 200 here. So I entered here 29.60. I position size correctly. I put my emergency stop 2 ATRs below. And then if I get a close below the 200, I am on a weekly, monthly basis, I am simply out of the trade. I place my 1.5 ATR trailing stop level up here. Next month, it just skyrocketed and I hit profit targets, took some profit targets off. This month also took some profit targets off. Now, because we're in trailing stop mode, it means if I have a close below a previous bar's low, I will get out of half. But in this case, that is not going to apply because earnings for Southwest are on the 27th of this month. And as I told you earlier in the podcast, if earnings come into any of my swing trades, I'm just going to get out. AKA, look what happened to Nvidia. Look what, or not Nvidia, Netflix, and Tesla as well. And to the upside on Morgan Stanley, if I would have been in those and held through those earnings, I would have been in deep trouble. And I'm not going to put myself in that position for Love. So Love's earnings are the 27th. I will get out right before earnings. But this particular trade doing very well, up 20.27%. Pretty good, huh? Not bad. Yeah, it's easy to make money in a bull market, and apparently it looks like we are in a bull market here. But regardless of what kind of market, you just need to follow the trend. So those are the trades that I took this week. We're going to do a little bit on trader psychology, and then we're going to look at the potential trades for next week as well. All right, let's talk a little bit about trader psychology. This is such a good post from Steve Burns. And if you don't know who Steve Burns is, great author, great trader, has written many books. And you can follow him on Twitter at @SJosephBurns. Take a look at some of his books. I actually wrote the foreword on one of his books. But this is such a great post. It really takes into account everything about trading. If you move from your expectations, predictions, and opinions to price action, signals with an edge, the market gets a lot simpler. Listen, every time I've gotten in trouble in trading, it was because I had an expectation, I had a prediction, or I had an opinion on where I thought the market was going to go. Sometimes I'm right, sometimes I'm wrong, but listen, I'm getting on my knees and begging everyone, follow the price action, not what you think the market should do. If the market, it keeps going up and you don't think it should keep going up, well, go with what the market is doing. The market is always right. Our predictions and our expectations and our opinions, the market doesn't care about those whatsoever. I'm just telling you from trading for the last 28 years, follow what the price is doing. Follow what the market's doing. Follow your signals. If you don't agree with what the market's doing, stay with the signals, because again, the market is always right, and it makes trading, well, here, and a price action signal with an edge, meaning that over the long term, that particular entry signal has been shown to make money, that the market gets a lot simpler. It can be extremely complicated if you start inserting your expectations, predictions, and opinions It makes it a lot simpler if you just follow the price action, follow your signals, even if you don't agree with what you think what the market is doing or why it's doing it. The market gets a lot simple, and therefore your life gets a lot more simple. Does this make sense? Like I said, I'm on my knees here, praying to you with my hands, begging you. Get rid of your expectations, get rid of your predictions, get rid of your opinions. Just follow price action. Your life is going to be a lot easier. The market's going to be a lot easier. Thank you, Steve. Wonderful, wonderful post with so much wisdom. And follow Steve over at S. Joseph Burns on Twitter, or take a look at some of his books on Amazon. They're really great books. All right, let's start getting into potential trades for next week. And by the way, if you like this podcast so far, if you found it valuable, I would really appreciate it if you could hit the thumbs up button. Helps to build the channel, helps to keep the channel around, lets YouTube know that there's some valuable content. So, okay, here we go. Like I mentioned at the beginning of the podcast, these markets are not where they need to be. I need them actually either to go lower and reject the level, or to go higher and trigger some other kind of entry signal. Well, excuse me. This is Baba, Alibaba. So here it is the weekend. I look at this chart objectively, and I look at this as very simple to see. See the 200-day moving average here? That is a key level. That level should act as support. That is a level that should bring in buyers. In addition to that, you see the big up bar we had here? Do you see how the 200-day moving average, I drew the green line here. It's the black line, but I drew the green line at the black line. If you follow this backwards, you see how that happens to dovetail with halfway of this bar? I was telling you about why halfway moves are so important from a Fibonacci standpoint. This makes a lot of sense. That if we get some kind of rejection of Alibaba next week, I don't know if we will, it might just continue to go up. And if it does, great. I'll just look for another market that gets to where I need it to be. It's very important on the weekends, even on the days, just to look at a market and go, what makes sense? Well, this clearly makes sense. If we have a close under, close over, or we have an intraday rejection of the 200, that is a good entry signal. Doesn't mean the trade's going to be a winner, but it's a good entry signal that gives me a very defined level. But the point is here, looking and waiting for the market to come down to the level that you are okay buying it at. Well, I'm okay buying it. If it goes down and closes below, I'm not interested. But if it goes down during the day, closes back up, I'll say, oh, the market responded and said there were no more sellers under the 200. Doesn't mean there can't be in the future, but it gives me an edge. Okay, so I am waiting for Alibaba to come down next week for some kind of rejection of the 200. If it does, I'll position size, I'll place my emergency stop. Where will my end of day stop be? Well, if it rejected the 200, then simply a close back below would get me out. Makes sense. And if it goes to the upside, well, then I'm going to start taking partial profits. If it gets to my trailing stop level, I'll go into trailing stop mode, and the process that I use and the process that I teach, right? So that's what I'm looking for on Alibaba, potentially entering Alibaba next week if we have a rejection of the 200-day moving average. Lockheed Martin. Well, Lockheed Martin, again, earnings did not react very well. This 250-day moving average, which we are not at yet, we have not tested it yet. Well, we did test it back there. But going forward, I want another retest. Look back here. Do you see how here it respected the 250 and had a nice rally above it? Here we came down close to it, rallied again. Here we tested it again, closed above. Here we almost tested it again, closed above. 3 days ago, we went below it, closed back above. The market is clearly respecting this 250-day moving average. Doesn't mean that in the future it can't lose it, but what I'm potentially looking for next week on LMT is another rejection of the 250-day moving average for a possible entry. NVIDIA. Well, of course, NVIDIA has been a high flyer, and we're getting to a key level here on NVIDIA. See this previous high here? This was resistance. And then over here, we broke through this resistance. Now, this old resistance level, about 440, is going to become support. And we've had 3 big down days on NVIDIA, and we're getting very close to it. But does this mean that I'm going to buy just if it touches this level? No. Big picture, there's a good chance that it will hold support here. But I am looking for what's called a return to value V1 or V2. And again, I teach these in my one-on-one courses that I do in the evening time via Skype. The 2 green lines are called the value zone. You want to buy in value and sell above value. A lot of people buy above value and then sell when it gets back into value. It's the complete opposite. I mean, look, here we were definitely above the value zone. Then we came back into it. Was that a good place to buy? It sure was. Here we were very far extended. I wouldn't even think about buying NVIDIA up here. But now we are back into the value zone. So does it mean I just go ahead and immediately buy? No, I am waiting for a very specific pattern for me to get interested in. And again, if you'd like to watch a video on this, I have it on YouTube in my YouTube channel. Look for V1, V2 entries. But we are in the value zone now. And I highlighted over here that this previous resistance now becoming support. What I'm looking for next week, now that we're in the value zone, I am looking for at least 2 days of sideways motion that doesn't take out this low. Or if we do take out this low, now that becomes the new low, then looking for 2 days of sideways motion and then looking for a V1 or a V2 entry. Because we had a huge move up, obviously. Now we're coming back into value. Just that alone is good. I'd much rather buy it here than up here. But again, I'm waiting for that very specific pattern where I need 2 days of sideways motion and then a V1 or a V2 entry. Okay, that's what I'm potentially looking for in NVIDIA. And then Qs, exactly the same thing as NVIDIA. Look, here's the value zone. We huge melt up, unbelievable. Look, here's the previous resistance here. Move this out into the future. I could definitely see the NASDAQ coming down lower and testing this previous support. But same with NVIDIA. Now that we're in the value zone, I want to see it move sideways for at least 2 days and then a V1, V2 entry. I know these kind of patterns are a lot different than me just looking at Alibaba and going, boom, there you go. There's 200-day. If it rejects that, I'll potentially take it. There's a little bit more patience with this return to value V1 or V2, but being that now some of these big stocks have actually come back into the value zone, I thought it was a good market to highlight. So on Qs, looking for a move into the value zone, 2 days of sideways motion, V1, V2. So real quick recap, Alibaba, I'm looking for a potential rejection of the 200 to potentially get long. Lockheed Martin, LMT, I'm looking for a rejection of the 250 to possibly get long. NVIDIA, looking for it to, now that we're in the value zone, look for a couple days of sideways motion, look for a V1 or V2. And also on Qs, same thing, 2 days of sideways motion on the Qs and looking for a V1, V2. So, we have earnings coming in, some of the big earnings, and that's definitely going to affect the market. I think the last couple days after earnings of Netflix and Tesla, I think it's changed the tenor, it's changed the sentiment of the market. I think the big rocket move up is probably over. But again, just like I talked about in trader psychology, that's kind of an opinion, right? So I'm going to follow. Yes, I do think that potentially the market has changed, but it may not. It may go right back up and all I had. But the main thing is that I look at the technicals, I wait for the setups and don't fight it. Okay, so those are the dailies that I'm looking at next week. Oh, and one last thing, it is potential that all of these potential daily trades could trigger all on the same day. Does that mean I'm going to rush in and buy all of these positions? No, I wait. I have a rule where I only buy one setup on a time frame per day. So here's the dailies. These could all potentially trigger on the very same day. I would narrow it down to the best one. Which one's the best one? The one that has the best risk reward ratio, the one that has the most confluences, combinations of signals, the one that looks best on multiple time frames. All right. And then weeklies, I don't have a lot on weeklies, but I have a couple. All right, here is GDX. GDX, I was trying to buy it all the way down here at the 300. If you remember, if you've listened to this podcast for a while, you knew that I was trying to buy GDX with the rejection of the 300, but it didn't quite get there, so I just didn't take the trade. But now that we've moved up significantly, do you see the purple 250 week moving average? This makes a lot of sense. We're not there yet. It's about 30.25. We're at 31.49. We had this huge move up. Having a pullback would make sense, but I'm looking next week for some kind of bounce or intra-week rejection of the 250-week moving average to potentially get long. I would enter position size. What would my end-of-day stop be or end-of-week stop? Simply a close back below that. And I like that this moving average has come into play inside the huge big week that we had 2 weeks ago. So a lot of people that bought down here, they're in the money a lot up here. They're selling, taking a little profits. That could easily move the market back to and test the 250-week moving average. But if it holds, then you could have a larger move up. All right. So just to be clear, next week looking for some kind of bounce or intra-week rejection of the 250-day moving average. And then last but not least, Nike. Again, I was looking to buy at the 300 over the last few weeks. Never quite got there, but I would be waiting for Nike to potentially come back down and reject that 300-week moving average. If it does, great, I'll consider taking the trade. If it doesn't, then I'll just get onto a new market. So there are not a lot of setups. We've had this huge market rally. We did have a little bit of a pullback in the SPY and the Qs. Of course, the Dow is stronger than all of them, and the IWM. But next week, be careful. We have more earnings. And if you are interested in studying with me and learning the skill of trading, I'd be very happy to have you as a student. I love to teach, and like I mentioned, I do teach a private one-on-one course in the evening time via Skype, 15 hours. It does cost $1,750, but I promise you it's worth every penny for the experience you're getting in your teacher and the patience that you're getting in your teacher, and you're going to learn a lot, all 5 of the trading approaches that I use. So if you're interested, all you have to do is send me an email. I'm actually currently booked up right now with my students, but we could still talk and schedule something in the future. But my email's in the description. All you have to do is reach out, say, hi, Greg, potentially interested in your course. I'll say, great. Let's set up a Skype call. The Skype call is free. I promise you, it's not a sales call. I promise you, I just want to learn more about you, your trading, what you're expecting out of the course. And it's a great time for you to ask me any specific questions about the course. And if you like what you hear after the call, then it's up to you. If you decide, hey, I want to take this course with Greg after our Skype call, just email me back. Say, hey, Greg, I'm interested or I'm not interested. Either way is fine. But I know you're going to learn a lot. I've taught people from all over the world. I've taught people from absolute beginners. And, a couple of months ago, I just finished up with 2 large hedge fund guys as well. So I'm a good teacher. I teach good trading principles. So if you're interested, just reach out to me. All right. Secondly, I mentioned this a little earlier. If you like online trading courses, I have a great online trading course at udemy.com. The link's in the description. It's called the Deep Dip Buy Stock Trading Strategy. All you have to do is click on it. It's for $12 or $15. You get 9.5 hours of video instruction by myself, 15 study guides, 23 videos, I believe. Usually I know that, I can't remember. But it's a great course. I've got a lot of so many good reviews and feedback from that course. Keep that in mind. If you like today's podcast, I would really appreciate it if you could hit the thumbs up button. Helps to build the channel, helps to keep the channel around, lets YouTube know there's some valuable content. And then last, and I always say this each week, please try to go out and do something nice for someone on a daily basis. It's going to make you feel good. It's going to make them feel good. It would make the world a better place. And also, if you could go also try to do one nice thing for an animal today, they would appreciate it. It's going to be good for you. And why not do one nice thing for a human each day, one nice thing for an animal each day? So I appreciate you listening, everyone. I hope you have a nice weekend. Be careful next week trading. Be careful every week trading. And God willing, I will see you next weekend. and we'll see what has happened with this crazy market. But thanks again, everyone. Appreciate you. And on the way out here, I have to run the U.S. legal disclaimer. Take care.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.